Go ahead and record this session. And so we have that basically our assets minus our liabilities equal net assets. We're going to be using this formula a lot next semester in BA 400. So you may want to familiarize with this as much as you can. So basically, it's our typical balance sheet formula, right? The accounting equation that you guys have looked at since the beginning of times, right? Our typical assets equal liabilities plus equity. This is just another way to rewrite that mathematically. And so just so that we're familiar with these terms. Okay, and so we said in terms of capital, we have our capital that's contributed from our shareholders when they purchase stock, and then we have also our accumulated earnings. Okay, so these are the two sources of ownership capital. There are different ways to, maybe you might find different names when you're looking at different annual reports for stockholders' equity, but they all pretty much mean the same. So in terms of shareholders' equity, we may be able to find paid-in capital. Sometimes it's called additional paid-in capital. Retained earnings, we may see treasury stock, we may see accumulated other comprehensive income. So we're going to be kind of going over these as we go through the presentation today. So in terms, we have here just the shareholders' equity of Exposition Corporation. I don't think you'll find, not even publicly traded, this many paid-in capital accounts in a real-life corporation. But, just, I guess, putting all situations out there. But pretty much this will be the shareholders' equity. So like we said, it can become pretty complex. You should be familiar with, you have a preferred stock, you have common stock. We said additional paid-in capital or paid-in capital, retained earnings, and then our accumulated other comprehensive income. Usually this is just one line on the balance sheet. They don't really break it down because the breakdown is shown on the statement of shareholders' equity. So we'll start with our paid-in capital. This is what we said is invested by the shareholders. This is contributed capital. Pretty much is the excess of par value of the common stock, right? If the common stock has a par value. We can also have paid-in capital if we need to buy back any shares, or we may have some share-based compensation. Okay, so we are giving our employees shares, so that may give rise to paid-in capital as well. Retained earnings are earnings accumulated on behalf of the shareholder. So you're pretty much very familiar with retained earnings. These are cumulative earnings and losses. We also have, and we know that retained earnings is also decreased by dividends, right? We also have treasury stock. So new, I guess, is treasury stock, which means that the corporation purchases its own shares. And then we have our accumulated other comprehensive income. If you recall, in BA 300 in chapter 4, when we were looking at the income statement, we also discussed other comprehensive income, or the comprehensive income statement, which is a statement that is right after the income statement. And the first line on that comprehensive income statement is net income from the income statement. And then we added or subtracted these gains and losses that kind of skipped. They were not reported on the income statement. They are reported on this special statement because I guess the reasoning behind that is that these gains and losses fluctuate. They're not part of, may distort actual net income of the company, and therefore we're gonna report them into this comprehensive income statement. So we have kind of like an example of the type of gains and losses that are reported. Some of these we were looking in the previous chapter, retirement. Remember the prior service cost amortization that was reported under other comprehensive income, and those mini adjustments to the PBO, which were gains and losses, was also reported under other comprehensive income. So next semester, we're going to be looking at foreign currency, which also uses AOCI. So we have an example of the statement of comprehensive income. If you have your annual report for your publicly traded companies handy, you can see how these are reported actually in real life. So pretty much like the example here. Okay, so expanded, and then we go to kind of like the definition of a corporation and the advantages and disadvantages. So you've seen corporations since BA 200. Pretty much textbooks have emphasized corporation over any other form. And so we know that corporations' advantages are that is a limited liability, basically that the shareholders' responsibility sort of ends with their investment, right? That the only risk that the shareholder has in investing in this corporation is the amount that they have actually invested. So how much you have purchased your shares for in the corporation, that's the amount that you're at risk. Creditors are not gonna come after shareholders to settle their debt. So that's very different from maybe a sole proprietorship, okay, that is more exposed in terms of liability. It's also easier to raise capital because we can just issue additional shares if we need monies, right? So in that case, we can raise capital. Owners or shareholders, you can sell your shares. There's no restriction on that, right? You can sell it to whoever you want to, back to the broker. So it's a lot easier. However, there are extensive reporting requirements. So there's governmental and state regulation for corporations. Does anybody know what is the requirement, the annual requirement for corporations on Guam in terms of filings to maintain their certificate? Anyone? How do we form a corporation on Guam? Heidi. Miss Heidi? How do we form a corporation in Guam? Yeah, so we're gonna have to file our articles of incorporation and the bylaws. So both we file those with revenue and tax, and we get our domestic certificate. Okay, so that's basically the two documents that are needed in order to sign or form the corporation. And then after that, we're going to have an annual filing for the corporation. It's like an annual where they just ask pretty much, I guess, an updated information about the directors and the address of the corporation. I think it used to be $100 or something like that. So those are local requirements. They could, depending on the industry that the corporation, like for example, a bank, then they will have federal regulations as well. Another disadvantage is double taxation. So the shareholders are taxed on the dividends that they receive from the corporation, and the corporation is also taxed on taxable income from the corporation. So the dividends are distributed to shareholders after tax, and then the shareholders are taxed again. So that's the double taxation. So if you ever hear about corporations double taxation, that's what they're talking about. However, corporations are very common, and so we can see them in different industries and sectors. We have not-for-profit corporations. We also have publicly held corporations and privately held corporations, all right? Sometimes they start as private and then they become public. And then we have hybrid organizations. One of those you may be familiar with is the limited liability company, or LLC. The good thing about the LLC is that it's very flexible. You could treat it as a corporation or you could treat it as a partnership. And so you can it allows for special allocations of income and losses to its members. So it provides that flexibility while, providing the limited liability. We also have limited liability partnerships. These are preferred maybe by, professional organizations like accounting firms, because in that way it kind of limits, instead of suing all partners or all partners being at risk of being sued, legal action can only be for just one partner, and so while protecting the other partners. So that's why it is a preferred form. We have a Model Business Corporation Act, and maybe you guys have seen this in more detail in your business law class. So basically, it just provides specification as to the certain documentation that the corporations must have. So one of those are the articles of incorporation that we mentioned, and the bylaws, etc. In the articles of incorporation, it just states like the firm's business, the type of business that they're going to be engaging in, who are in the board of directors, and then it also talks about the shares to be issued. So I kind of want to touch on that just to make sure that we sort of understand. So in the articles of incorporation, we're going to have to mention how many shares we want authorized. And so this is like the authorized is the amount of shares that we could issue, okay, throughout the life of the corporation. Since we think that the corporation is going to last for many years, then the amount that's authorized usually is huge. I don't know, 1 billion shares, all right? So that doesn't mean that we're going to have 1 billion shareholders. It just means that we're authorized at any time throughout the life of the corporation to issue up to 1 billion shares, all right? And then from that, we actually have the shares that are outstanding, okay, or the shares that have been issued, okay? So we have issued X amount of shares. So these are actually in the hands of outsiders. And then we have these shares that are outstanding. So that means that these are being held by our shareholders. And if we have, usually these are the same. The amount of issued shares equals the number of shares outstanding. That's supposed to be a hand, by the way. And however, there might be a difference when we have treasury stock. So when we have treasury stock, our number of issue shares will be different than shares outstanding. So we have fundamental share rights. So when you're a shareholder, you get these rights, right? The right to vote. If you're a common stockholder, you have the right to vote. To elect the directors, the right to share profits when dividends are declared, the right to share the distribution of assets if the corporation were to liquidate, and then we have a preemptive right. This is that you may or may not have this to maintain one's percentage share of the ownership when the shares are issued. So basically, if you have right now a 10% ownership in XYZ Corporation and XYZ Corporation issues additional shares, you want to maintain that 10% ownership. You don't want that to be diluted and you're going to end up with 2% or 5% ownership. So they have to actually, if there's a preemptive right, that means it doesn't matter how many additional shares the corporation is going to issue, you still maintain the same 10%. So you're going to get more shares, but you still have that same 10%. And I kind of wanted to show you or share with you this short video from the social network. Let me just which makes reference to when they diluted the shares of one of the founders of the social network or Facebook. I don't know if you guys have watched that movie. So it's just a clip from the video. We're not watching the whole entire movie.
Mark! He's wired in. Sorry? He's wired in. Is he? Yes. How about now? You still wired in? You issued 24 million new shares of stock. You were told that new investors came along. How much were your shares diluted? How much were his?
What was Mr. Zuckerberg's ownership share diluted down to?
It wasn't.
What was Mr. Moskowitz's ownership share diluted down to?
It wasn't.
What was Sean?
Can you guys see the video or no? You can see it? William, can you see it? Maybe just try refreshing. Try refreshing.
Parker's ownership share diluted down to?
It wasn't.
What was Peter Thiel's ownership share diluted down to?
It wasn't.
And what was your ownership share diluted down to?
0.03%. You signed the papers. You set me up. You're gonna blame me because you were the business head of the company and you made a bad business deal with your own company. It's gonna be like I'm not a part of Facebook.
It won't be like you're not a part of Facebook. You're not a part of Facebook.
My name's on the masthead.
You might want to check again.
It's because I froze the account?
You think we were going to let you parade around in your ridiculous suits pretending you were running this company?
Sorry! My Prada's in the cleaners! Along with my hoodie and my fuck you flip-flops! You pretentious douchebag!
Security's here. You'll be leaving now?
I'm not signing those papers.
We will get the signature.
Tell me this isn't about me getting into the Phoenix. You did it. I knew you did it. You planted that story about the chicken.
I didn't plant the story about the chicken. What's he talking
You
about?
had me accused of animal cruelty.
Seriously, what the hell's the chicken?
And I'll bet what you hated the most is that they identified me as a co-founder of Facebook, which I am. You better lawyer up, asshole, because I'm not coming back for 30%. I'm coming back for everything. Get him out of here. It's okay, I'm going. Hang on.
Honest to God. Here's your $19,000. I wouldn't cash it, though. I drew it on the account you froze.
I like sitting next to you, Sean. Makes me look so tough.
Okay, so now I'm trying to come back to the presentation. Where are we? Here. All right, so basically, they were just showing a clip of, where's my presentation? There's my presentation. Maybe I need to refresh. You guys still see the video?
Yes, still in the video.
You still see the video, okay. Trying to get rid of the video. And okay, I got it. Okay, so basically what they were showing there was that one of the founders had initially a 30% share, and then they kind of issue additional shares and they diluted his interest to 0.03%. Okay, so that's the preemptive right. So that's basically what we're talking about here. The corporation may also have different classes of shares. So in these different classes of shares will have different rights. Okay, so that's something that, that's just to entice, kind of provide options to the shareholders. And then we have like the preferred stock shareholders. Okay, preferred stock shareholders. Not all corporations have preferred stock. So preferred stock shareholders do not have the right to vote like common shareholders. So they give up that right, but instead they have the right to receive their share of dividends first. Okay, so they get first dips on that. And then if the corporation were to liquidate, they also get first dips on any assets that are liquidated. Okay. And when we're talking about preferred shareholders, there's also different types of preferred shareholders. Your preferred shares could be cumulative. So that means that any dividends that were declared but not paid, they will carry over to the next period when the corporation is able to pay it. Okay, so those are called in arrears. And then or it could be non-cumulative. And then we have participating or non-participating. So with the participating, if they may receive also additional dividends, okay? So there's also a type of preferred shares that are convertible, and or they need to be redeemed. Okay, so there's a certain period of time where the preferred shareholder needs to redeem or give back those shares to the corporation. So if it's a mandatory redeemable preferred shares, then those are treated as debt. Okay, because the corporation has an obligation to repurchase those shares no matter what. So this obligation is going to be stated as a liability on the corporation's balance sheet. Something that is kind of changing under this Corporation Act that we mentioned previously is par value. And par value, sometimes students get confused par value with market value of shares. Par value is arbitrary. Okay, so we need to remember that. This is just the board of directors getting together upon formation of the corporation and deciding on a par value for their common stock. Okay. Now, because we don't want the market value or market value could drop below par value, and if that's the case, we're going to have a negative equity on the balance sheet, and we don't want that to happen, then corporations started changing par value to like cents. Okay, so giving par value cents. And so, but eventually, under this Model Business Corporation Act, they want to eliminate the par value. But however, a lot of corporations still maintain par value, and that's why we need to actually understand how to treat it for, in our journal entries. So in terms, I don't know if we need to explain that now or when we're looking at dividends, but in terms of, we talked about the preferred shares, when they are cumulative, that the dividends in arrears, we need to calculate what is going to be paid. So this is a pretty good example of that. We have that our preferred stock is 6% cumulative preferred stock, and when they have a percentage, that means the amount of the dividend. So their par value is 400,000, so 6% of the 400,000 is the dividends that we're supposed to get paid as preferred shareholders when we have that right once the dividends are declared. So they've told us that, and declare means that the board of directors get together and they said, okay, we approve the payment of dividends, and that goes in the minutes of their board of directors meetings, and that's a dividend declared. And so we're gonna need a journal entry for that, and we're gonna see more of that when we're looking at dividends later on. So in terms of in arrears, we have that in 2019, we had 40,000 of dividends, and so the first 24,000 is going to be paid to our preferred shareholders, and the common shareholders get whatever is left. Okay, they get whatever is left. For 2020, we came short because we were supposed to get paid 24, but the corporation only declared 20,000 of dividends. So this 4,000 is going to carry over because it's cumulative until we have sufficient funds to cover whatever is in arrears. And so in 2021, we paid 50,000 of dividends. 24 of that is going to be for our preferred shareholders, plus the 4,000 that was carryover from 2020 that we still owe them. And then whatever is left of that 50,000 will go to our common shareholders. Okay, so that's what we mean by cumulative preferred stock. Okay, so when we, as a corporation, sell the shares, okay, we are selling the shares at market value. And we said the market value is not the same as par value, right? So there's going to be a difference. In that difference, we are going to credit to our paid-in capital, okay? This paid-in capital, we're going to distinguish from other paid-in capital, and we're going to call it excess of par. When we issue, so this is if there is a par value. If there is no par value, then we debit cash and we credit common stock. All right, we can also issue shares in payment of legal fees or professional fees. I mean, I haven't really experienced that in real life, but it is possible. We can also pay with, issue shares to pay for fixed assets like property, plant, and equipment and things like that. Okay. If we are going to issue stock to purchase property, plant, and equipment, or any other type of asset or professional service or anything else, then we need to assess the fair market value of that. And, how are we going to measure this transaction? So we're either going to use our fair market value of the stock or the fair market value of the asset or service that's being paid or purchased. Whichever we are able to determine, okay? So in this case, I think we're using a quoted market price of the shares to value the property, plant, and equipment that we are obtaining in exchange. If we have more than one security that's being issued, like a lump sum, okay, I'm gonna issue common stock and preferred stock for one lump sum price. In that case, we're gonna have to do an allocation. We're gonna use the one that we are able to determine, the value that we're able to determine first, and then we're just gonna plug the difference to the security that we actually don't have a value for. So we have an example here. We have APMP issues 4 million of its common shares, $1 par value, and 2 million of its preferred share of $5 par value for 100 million. And then we have a market price for a quoted market price for our common shares of $10 per share. So we're gonna allocate this 100 million to the value using the value that we know first, and then we're gonna plug the difference to the preferred shares, which we don't have a value for. And so we are able to determine that the common stock, if we take 4 million shares multiplied by 10 is 4 million, right? I'm sorry, 40 million. So we have that 4 million will be our common stock. So again, common stock is always credited at par, okay? And then the difference between par and the per share value is credited to paid in capital in excess of par. So the 40 million is allocated to the common stock first. And then we do have a par value for our 2 million shares of preferred stock, so we can determine that. And then we usually plug that difference to our paid in capital excess of par preferred stock. Okay. So hopefully that makes sense. If there are any share issue costs, actually, I don't like this example because it kind of netted the amount in the cash that was received. But technically speaking, when you have a share issue cost, it's taken out of paid in capital. So if you have to pay any share issue costs, you're going to have to debit paid in capital and then credit cash. All right, and then we have our shares repurchase. So there's, our treasury stock. Basically, your book actually segregates it into two groups: the share repurchases and then the treasury stock. We're just gonna concentrate on treasury stock. Basically, the company is buying back its share, and it could be for many different reasons. Maybe if they limit the supply of shares, it may raise their price. Okay, so maybe they're looking for to add value to its shareholders, and that's a way to do it. Maybe they want these shares to pay their employees, to compensate them. So by giving them shares is also a form of compensation. Okay, so different ways or reasons for purchasing their own shares. Okay, so shares could be reacquired to give a stock dividend. So instead of paying them cash dividend, I could give them stock in exchange. It could be maybe because I'm looking to purchase another company. All right, and this is something we're going to be looking at next semester. It could be maybe I'm trying to prevent a hostile takeover. Maybe there's another shareholder who's purchasing all of the shares or trying to obtain control in this corporation, and therefore by the corporation purchasing its own share, it prevents that from happening. And so we have two types of share repurchase. We have shares that are retired, okay? And we also have treasury stock. So the most common one is shares treasury stock. And you probably have some of that if you're looking at your annual report for your publicly traded company. Then you'll notice that, and also talking about the publicly traded company on your research project, I want you to use that same company that you had selected at the beginning of the semester. So we are going to reiterate that or repeat that again once that I post that form for that project. Okay. All right. So here we have that we are reacquiring 1 million of shares of this corporation, or American Semiconductor is purchasing or reacquiring 1 million of its common shares. And we can see that they already have 2 million of capital, of paid-in capital from share repurchase. Okay, so this is information that we may need when we're dealing with purchase or repurchase of shares. So here we have an example. Let's assume that we are going to repurchase this 1 million shares for $7 per share. So we're going to skip over this retirement, all right? And we're going to concentrate on the treasury stock. So if I'm just repurchasing the shares, then I'm going to debit treasury stock for the $7 per share, and so $7 multiplied by 1 million, so 7 million, and then credit the cash for 7 million. All right, and I have to keep track of this cost in case I decide to reissue the shares. Okay. So here we have case 2 where we have repurchased shares for 13 per share. So instead of 7, now it's 13. So in dealing with, again, we're not looking at retirement, we're looking at treasury stock. So I'm just going to debit treasury stock for that cost. 13 per share multiplied by 1 million is 13 million. And then all right. So the effect of treasury stock on shareholders' equity is that it's going to decrease equity. Okay, treasury stock decreases equity. All right. Okay, so we have here an example of our treasury stock. We can see that treasury stock reduces equity. Okay, so here is reducing equity. That was the 13 million. Now, if we decide to reissue the previously purchased shares, we need to keep track of the cost, we said. So we purchased the shares, or we repurchased the shares for $13 per share, so it was 13 million. And now we're gonna take all those shares, all those 1 million shares, and we're gonna sell them back to shareholders. So, but this time the price that we're selling it for is $14 per share. So never mind this. I'm just following that information. We're doing treasury stock. So the cash that we received is the amount of the market price of this share. And then we're crediting, before we debited treasury stock when we first repurchased the share. Now that we are reissuing the share, setting it to outsiders, we're going to credit treasury stock. Therefore, we're going to zero out our treasury stock account for the cost, the initial cost. And then any differences are going to be credited to capital, paid in capital. Okay, and we have a little title there, share repurchase. It could also say treasury stock, depending on the textbook. And here we have that instead of selling it for 14, we're selling it for 10. Okay, so this is a different scenario. So in that case, the cash that we received was 10 million, all right? We still have to credit treasury stock for 13 because that was the initial cost of the shares, the 1 million shares. And we have a difference. So first of all, that difference is going to be debited to the account that was already in existence before, which was a paid in capital share purchase account. If you recall, when we were looking at that balance sheet, where is it at? Oh, here we go. We were looking at the balance sheet. We had this paid in capital share repurchase of 2 million. So these deficiency is going to come up from that account first. Okay, so it was increasing equity. That means it was a credit. So now we're debiting it. And then we still have a difference. So that difference will come out of retained earnings. Okay. Okay. All right. Now we're talking about retained earnings. Now you guys should be familiar with retained earnings. Our retained earnings starts with the beginning balance as a carryover from the previous period, and then is increased by net income or decreased by net loss, and then decreased by dividends, any dividends paid. Okay, so that's basically the movement of retained earnings. There could be a prior period adjustment, which we're going to take a look at in chapter 22, I believe. So that's something that we're just going to put a pin on that for now. So retainers, we know that dividends come out of retained earnings, okay? So corporations are going to distribute dividends to their shareholders out of retained earnings, which is their cumulative earnings. They may also pay dividends out of paid-in capital or additional paid-in capital, and those dividends are called liquidating dividends, okay? Retained earnings may have certain restrictions, and if that's the case, there'll be a note on the financial statements just stating that maybe we're earmarking these for expansion, different options that the corporations have, or projects or plans, and so these funds are unavailable for dividends. Okay, so they're restricted in a way, but we don't need to actually do a journal entry for that. So the most common dividends are cash dividends. So there's actually, the corporations is not really obligated to pay, but it's to entice shareholders, right? Who wants to purchase stock if I'm not going to get a return on that investment? And so that's what cash dividends are. We're getting a return on our investment. Okay, and so we need to pay attention to when the dividends are declared, because we're going to need a journal entry for that. That's when the corporation has the obligation to pay its shareholders once it declares the dividends, right? So we're going to have to do the journal entry for that. And then retained earnings are going to be reduced. Dividends come out of retained earnings. And until the dividend is paid, we're going to have a dividend liability. All right. So sometimes the problem or the exercise may mention a date of record. This is just a memorandum. It's basically when just administrative, make sure that we have the names of our shareholders, their addresses, bank account numbers, etc., so that we can pay our dividend. Okay, so we have an example here of a cash dividend on June 1st. The board of directors of Kraft Industry declares a cash dividend of $2 per share on its 100 million shares that are outstanding, right? So we're only paying dividends on shares outstanding. We don't pay it on the authorized shares. If you recall the difference between those three groups, maybe you want to go back to the recording of this presentation and take a look at that again. So we have here that once we declare the dividend, okay, we need to set up the liability. We need to have that liability on the balance sheet. So we're going to debit retained earnings, dividends come out of retained earnings, and we're going to credit the liability. And then we don't care about these memorandum. Okay, so we're just looking at the record. This is all administrative. We only care about the journal entry for the date of payment, where we're going to debit dividends payable and credit cash. Okay. I think this is just an explanation again of our preferred shares cumulative in arrears. I'm just going to skip through that because we have already explained it. In addition to cash, the corporation may also give us or the shareholders property dividends, right? Property dividends. So if that's the case, if they're going to give us property instead of cash, then we have to make sure that our property is updated in terms of its fair value. Okay, we need to reflect the fair value on the balance sheet before we distribute that asset to the shareholders. So we may have to increase or decrease its value accordingly. So in this example, for example, we have on October 1st, the Board of Directors of Kraft Industries declares a property dividend of 2 million shares of Beeman Corporation's preferred stock. Kraft had purchased in March as an investment, book value of 9 million, the investment shares. So we the shareholders are going to, we the corporation are going to give the shareholders securities in other corporation. Okay, we're giving them, that's our asset, that's the property asset that we are distributing to our shareholders. However, in our book value, excuse me, our book value of these shares is 9 million, but the fair market value is 10. So we need to increase it to fair market value before we distribute the property. So we're going to recognize a gain from the step up in value, and then we're going to debit retained earnings, because remember, all dividends come out of retained earnings, and then we are going to credit our property dividend payable on the declaration date. All right, and then when we finally pay it, we debit the liability and we credit the property. What was this example about? All right. Then we have a stock dividend. So again, instead of giving them cash, we are going to give our shareholders stock. Okay, we're going to give them stock. So remember that we want to keep the shareholders' ownership proportional. Otherwise, we're going to have that Facebook issue. So if they have a preemptive right, we need to make sure that they continue to have that same ownership. So an example of a stock dividends. Now, there's a stock dividends and a stock split. Okay, if the stock dividend is less than 25%, then we're going to use fair market value. We're going to use fair market value. So if less than 25%, we're going to use fair market value. And so in this case, the Kraft declares and distributes a 10% common stock dividend on 10 million shares. So 10% of 10 million when the market value is $12 per share. Okay, so 10 millions multiplied by 12. Since this is less than 25% common stock dividend, then we're going to use the fair market value of the shares. We're going to debit retained earnings for that value. Common stock is always at par, and then the difference is going to be credited to paid-in capital. Okay. All right. So stock dividends, is pretty much giving the shareholders the illusion that they're receiving a real dividend, but not really. They're just getting additional shares, but they may maintain the same ownership percentage. And as we mentioned before, we may also have a stock split. And the stock split, one of its objectives could be to decrease market price. Okay, I'm still waiting for stock splits for, Amazon, Google, one of those that has a very high per share price, but there's no stock splits in the horizon for those companies. And so stock split, again, one of its objectives is to decrease market price, to increase, marketability. Maybe you want to have a larger number of potential shareholders. Okay, so the stock split will achieve that. With at 100% stock dividend, that's a 2-for-1 split. Basically, the outstanding shares are multiplied by 2. But our market price is split in 2. Okay, so it's divided by 2. So it has decreased market price while increasing shares. That's 100% stock split. Okay, and so a stock distribution that is 25% or higher, remember the stock dividend? We said if it's less than 25%, then we're going to use market price. If it's 25% or higher, then we're going to use the par value of the stock. So we have 100% stock dividend, and so we're going to use the par value. Here we're told that per share the value is $12, but we're ignoring that because the percentage is greater than 25%, so we're using par value. We are going to, don't do this, we're going to debit retained earnings, and we're going to credit our common stock. Okay. Don't worry about the reverse stock split. Don't worry about fractional shares. Don't worry about quasi reorganizations. This is the quasi reorganization is kind of like hitting the reset button. Okay, it's a company that's been in trouble. They have a deficit in retained earnings and they want to start over, and they have that capability. They still have a chance to make it. Therefore, they can elect to do a quasi reorganization. But this is just FYI. We don't need to worry about this. Our lives are complicated enough. Okay, so no quasi reorganization. I think that's pretty much for this chapter. Does anybody have any questions?